Good morning. I hope as you're watching this, everyone is staying safe and wish all of those affected by the virus a quick recovery. My goal during this time is to stay in constant communication with all of our clients. Over the last week, I wanted to share with you info that I've been hearing on calls with economists and managers. Today, I want to bring some clarity to where the economy is, where we expect it to go, and a potential end. We certainly don't have the crystal ball, but this is important to keep in mind, remembering the big picture, as I always talk about, as the news seems to be only focused on the short term and heightening investor anxiety. It's important to remember that we came into this last month with an extremely strong January and February in U.S. economy. 273,000 new jobs were added in both January and February, and housing had its highest 3-month average from December through February, which is the highest since 2007. The closure of restaurants and businesses, along with social separation, is going to drastically hurt the second quarter numbers, as spending has come to a complete halt, unemployment numbers are going to drastically increase, and the housing market is slowing down. Now, the stock market, which had its fastest 1-month decline since the Great Depression, has already factored in, or did factor in before this increase, a 60 to 80% decline in corporate profits, which is hopefully worst case scenario. With the focus on the pandemic in the US, Italy, and Spain, we haven't really heard much or had much attention being focused on what's going on in China right now. After 2 months of a near total lockdown in many parts of China, China seems to be getting back to business. Shanghai, Beijing have started returning to rush hour traffic jams. Most of China's big automakers have reopened their factories, and housing sales are ticking upwards. Important indicators like electricity and steel demand and auto manufacturing returning to levels not too far off from normal. The basic message coming out of China is that this was a sharp interruption, but that GDP should bounce back to normal or where it was before. The bounce back or the holdback right now, though, is because of China's major export markets and the trailing or trading partners that we have in Europe and the US. It's really kind of holding them back from having a true full recovery right now. This is encouraging to all of us as we see signs and kind of see what's in the forecast for Europe and the US right now in the middle of this pandemic, and it seems like there's no way out. Can we just swallow a horrific second quarter and get back on a healthy economic recovery in the rest of the year? Most forecasters seem to feel that the recovery and world economies to have a V-shaped recovery in the third and fourth quarters, despite their catastrophic projections here for the second quarter. Our view is that as data turns here in the US, panic will begin to subside. The key factor in all this, though, is how long our economy is going to be put on pause. The quicker the government can allow restaurants and other businesses to open, the quicker we'll see a recovery start to happen. While we all want this to happen sooner than later, it's hard to do with continued spread of the coronavirus. Volatility slowed this past week as the U.S. markets had its biggest one-day gain and 3-day gain since the Great Depression, as congressional leaders reached out and reached a deal on a $2 trillion stimulus package. Germany, Japan this past week as well passed huge economic stimulus packages, and China is thinking about cutting rates for the first time since 2015. Investors applauded these economic moves to help lessen the downside on the economy and help speed up the recovery, but they won't restore the economy on its own. What we've been discussing on calls is a market recovery back to kind of where we normally will occur on 3 items. 1, a stimulus package to help get us through this crisis and really lessen the economic damage or burden to workers and businesses. Number 2, we're looking at the numbers start leveling and peaking from its high. And we're seeing that already happening in South Korea and China. Number 3 is a plan on reopening this economy back up. We're optimistic that this could be a V-shaped recovery and that the pace the economy was on could quickly recover. We feel this way because of 4 of the 5 fundamentals to a strong economy remain in place. Low taxes, low regulation, a sound monetary policy, and a trade war that's subsided. Now, the 5th is an item that is a negative, and that's government spending because of our stimulus package, which will hurt growth long term. But in the short term, it's a necessary thing to get us to bounce back. In the short term, though, we aren't out of the volatility yet, as we haven't really started seeing encouraging signals of a leveling off of the numbers of new cases and a definitive plan on how this is going to open up the economy. I want to keep everyone on the big picture and participate in the market recovery as it will happen, as we hope this is a short-term issue. Trump is predicting that that he can open the economy back up here very shortly. But if it lasts longer than that, we still are optimistic that we can follow China's lead in the recovery to our economy. As always, please reach out to me if you're concerned about anything or if I can help with anything during these times. And as that's what we're here for, to keep you in pace with your long-term objectives and constantly keep in touch with everyone. Thank you for listening.